We managed to finish. We looked at the Cape Town property. We did some journals for that property. And we also looked at the Bloemfontein property. That was the property where we ended. So let us read the rest of the question. There are two properties that were remaining, one in Durban and one in Joburg. All right. So let us look at paragraph 4. On 30 September 20X5, Snake Limited leased its old head office building in Durban to a tenant. The original cost was 4 million and it was acquired on 30 September 20X3, on which date the total useful life was 10 years and its residual value was nil. The fair value was 3.7 million on 31 December 20X5. The fair value on 30 September 20X5 was equal to its carrying amount. So what are the characteristics of this property? Has there been a change of use in this property? Someone says they can't see the screen. Can you see my screen? Can you see my screen?
No, we can't say. Oh, now we can.
Okay. All right. So this property, the Durban property, what are the characteristics of this Durban property? Okay, there's something in the chat. Someone still cannot see the screen. Maybe you just have to, if you still cannot see the screen, you should just leave the team meeting and then come back into it because others can see it. All right, so this Durban property was a head office. It was used as a head office, which would have been classified on 30th of September 20X5. New tenants came into the building, so the property then became investment property and will therefore, from the date 30 September 20X5, have to account for the property in terms of IAS 40 investment property. All right, so what do we have to do? Since it was PPE, would have had to account for PPE from the date of acquisition. And we go back to the accounting policy. The policy tells us that Snake Limited applies the fair value model to investment properties and the cost model to its property, plant, and equipment. So let us look at that. From the date of acquisition up to the date of the change in use, we have to account for the property as PPE. I'll go to the workings. Okay, this is the Durban property. The cost price of the Durban property, we were given a cost price of how much? It was 4 million. The cost price of the Durban property was 4 million. Okay, that was given to us, told us that the original cost was 4 million, which was acquired on 30 September 20X3. Now we know that the year end of this company is December. We're told that the financial year ends 31 December. So that's 31 December each year. So we would have to account for depreciation on this property at acquisition, since it was accounted for, since it was treated as property, plant, and equipment. So the depreciation per annum would be 4 million divided by 10 years. Is the useful life 10 years? We're told that the useful life is 10 years. All right, there you go. And it had a nil residual value. So depreciation per annum is equal to 4 million divided by 10 years. Your depreciation per annum is 400,000. So your depreciation in 20x3 would be 400,000. That's your depreciation for 12 months. However, this asset was acquired on 30th of September 20x5. All right. So it means we'll have to depreciate it from that date up to December. So we'll depreciate it for October, November, and December. So we'll depreciate it for 3 months initially. So 400,000 times 3 over 12. We have an amount of 100,000 for 20x3. Depreciation for 20x4 would be the whole year 400,000. Right? And then a depreciation in 20x5 would be 400,000 times 9 over 12. Why is it times 9 over 12? The change of use occurred on 30th of September 20x5. That's when the change of use occurred, all right? The change of use occurred on 30 September 20x5, and we are in 20x5. So if you count from January up to 30th of September, that is 9 months. So depreciation for 20x5, that's 400,000 times 9 over 12. That would be your depreciation. All right, that is your total depreciation. Are there any questions? Rudolph says Rudolph still cannot see the screen. The rest of you, can you see the screen?
Yes, sir.
Rudolph, it must be your network. It must be a network. You can watch the recording. All right, it must be a network. Maybe your network is a bit slow. The others can see the screen. Maybe try and reconnect again. If you can reconnect again, then you should be good. Try and reconnect again. Okay. Are there any questions so far?
Sir?
Yes, go ahead.
Please repeat, how did you get that depreciation of 20x4?
20x4 is just the depreciation for the whole year. We already
Yes,
calculated, all right? So 20x4 is depreciation for the whole year. Okay. So these are the calculations relating to the Durban property. I don't think there are any other calculations that we have to do in terms of the Durban property. We have the depreciation calculations. Maybe we have to do calculations. We have to do calculations regarding the fair value adjustments. All right. So let us go back to the question and see what the question tells us. Okay. The fair value on 30 September 20x5 was equal to its carrying amount. What does this tell us? do we have to do any adjustments to fair value on 30 September 20X5 when the change of use occurred? Do you have to do any adjustments? If the fair value is equal to the carrying amount. Since the fair value is equal to the carrying amount on 30 September 20X5, there's no fair value upward or downward adjustments because the two amounts are equal. However, we have been told that the fair value was 3.7 million on 31 December 20X5. The fair value was 3.7 million on 31 December 20X5. All right. So what does that mean? What does that mean? Anyone? Let's see, I think there's something in the chat. Okay, who's this person? I'll have to find out who this person is. All right. Okay, so let us continue with this example. First of all, we have to determine what was the carrying amount on 30 September 20X5. So the carrying amount on 30th of September 20X5 will be your cost minus accumulated depreciation. So carrying amount at 30 September 20X5 is your cost minus your accumulated depreciation. That's your cost minus accumulated depreciation, which is your 4 million minus depreciation for 20X3 minus your depreciation for 20X4 and minus your depreciation for 20X5. I hope that this is correct. Am I correct here?
No, so it should be 3 point.
It should be 3 point. Hello?
I think it should be 3.2 million.
3.2 million. Okay. So I forgot to subtract the depreciation for 20X3. Okay. All right. So it's 4 million minus the depreciation for 20X3 minus depreciation for 20X4 minus your depreciation for 20X5. So our carrying amount at 30th of September is 3.2 million. All right, that's 3.2 million. And on this date, this is the date that we had a change of use. All right, so in that instance, owner-occupied property became investment property. Let me do the journals for it. You are not required to do the journals, but I just want to do it for the sake of completion. So this is the Durban property. The Durban property on 30 September. Okay. We have a change of use in the property. It changes from being owner occupied to investment property. So we debit our investment property, 3.2 million, and we credit our PPE, 3.2 million. All right. So a narration is just to transfer PPE to investment property on change of use. All right. And what else do we have? What further do we have with regards to this property? We're given another fair value. The fair value on 31 December 20x5 is 3.7 million. So this investment property has increased in fair value. All right. So we will have to do a fair value adjustment again. Okay. So we'll have a price or fair value at 30 December 20x5 minus fair value at 30 September 20x5. So that amount is 3.7 million minus 3,200,000. Then we should get an amount of 500,000. Are we together up to here?
Yes, sir.
Okay, so the journal entry at 30 December, 31 December 20x5, we debit our investment property since it's increasing in value. We debit it by 500,000, and then we will credit our fair value adjustment. We'll credit our fair value adjustment of 500,000. Right. These journals, obviously, they're not required, but I need to do everything here for the sake of completion so that you understand exactly what is going on. We haven't answered the question yet. We're still doing workings. Okay, now let us deal with the last property. The last property is a property in Johannesburg. We have a property in Johannesburg. So let me do my calculations. Okay. We'll just say Joburg property. On 30th of September 20x5, Snake Limited evicted the tenants from a building in Johannesburg and instead moved its head office into the building. On this date, the fair value was 4 million and the remaining useful life was 5 years. The residual value was 500,000. The fair value of this building was 3 million on 31 December 20x4. What happens to this Joburg property? Anyone? What happens to it? Is there a change of use evidenced in this Joburg property? Okay, go ahead.
Yes, sir. It changes to PPE because it's used for administrative purposes.
Exactly. So this is a change of use. It was investment property and it changes and it becomes PPE. All right. So there aren't actually many calculations that we can do in terms of for this Joburg property. The only thing that I can see here is on the date of change in use, there is a fair value. There's a change in fair value. All right. So on the date of the change in use, the fair value was 4 million. However, when the building, the fair value of the building on 31 December 20x4 was 3 million. So we can see that the building on the date of change in use actually increased in value. It increased in value to by 1 million. All right, there's a fair value adjustment of 1 million. All right, so that is the only one that we'll have to do. For the Joburg property, there's a fair value adjustment. Let me go and deal with the journal. Okay, I'll just copy this. I'll deal with the journals. On what date was it? 30 September 20x5. Right? We have investment property increases in value. I'll just do the calculation here. It's 4 million minus 3 million. And the value is 1 million, the fair value adjustment that we have to account for on 30th of September. All right. Now we can do our note. Investment property note. Excuse me. What is happening? Okay, let us deal with our note. So I've done it previously. I will just display the note. All right. So you'll always start. Let me hide these. Just want to hide that. You always start with the title of the company, Snake Limited, notes to the financial statements for the year ended 31 December 2025. These days, you'll see most companies will say for the reporting period ended. So that's the better way to reflect it, for the reporting period ended. And this is the investment property reconciliation note. We already dealt with the investment property at cost. Yesterday, we dealt with the investment property at cost. All right, so we won't go through that, and I think that was the Cape Town property. Today, we're just dealing with the investment property at fair value. All right, so our calculations, this is where our calculations and the information become very important. Okay, so we have 3 properties that are measured at fair value. We have the Bloemfontein property, the Durban property, and the Joburg property. If we look at the Bloemfontein property, the Bloemfontein property changed from inventories to investment property during the current year, and the same is relates to the Durban property, which was changed from PPE to investment property on 30th of September. Only the Joburg property had been investment property since the beginning. So our opening balance, the fair value of the investment property on 1st of January 20x5 was 3 million. All right, and where do we get the 3 million from? Let us look at the theory. It tells us the fair value of the building was 3 million on 31 December 20x4. So this 3 million we were given. All right, the 3 million we were given. Then the rest, we have to deal with the transfers. All right, we had 2 transfers during the year. Let me unhide this. All right, and this is where our workings become very important. Let me go back to the workings, okay? This is the workings. What am I doing? All right, so let us look at the date when we had the transfers. Let me clear this field and use another color. Okay. Why it's not working? want to remove that. All right. So let us look at this. The first one is the first time we had a transfer on the 1st of March from investment properties, from inventories to investment property. We debited our investment property. All right, so it means when we debit our investment property, we have to include it in our investment property. Okay, and then I'm not going to look at the fair value adjustments for now. I just want to look at additions or transfers where we had a change of use. The Durban property was also the same on 30th of September 2015. We had the 3.2 million where the property changed from owner-occupied property from PPE to investment properties. And those two are the only transfers we had. All right, transfers into investment property. All right, so we put it there. The Cape Town building transfer from inventory to PPE to investment property, the 800,000, and then the Durban building transfer from PPE to investment property is the 3.2 million. All right. Are we together? Hello?
Yes, sir.
All right. And these transfers occur during the year. So there are movements during the year. This transfer or Cape Town, the Cape Town building occurred on the 1st of March. So that is a transfer during the year. And the Durban building occurred on 30th of September. All right. So that is also during the year. That's why we show it under movements for the year. We don't include the values of these buildings in the opening balances. The presentation is very important. Where you allocate the figures will determine whether you get the marks or not. So make sure that you allocate the figures under the correct headings. All right. So we had another transfer, but in this case, we had a transfer out of investment property. We had a transfer out of investment property. I didn't prepare the journal entry. Okay, this was my mistake. This was for the Joburg property where we had the transfer out. This was on 30th of September 2015, where it said, let me go back to the question. On 30 September 20X5, Snake Limited evicted the tenants from a building in Joburg and instead moved its head office into the building. So that building changed from being investment property and it became owner occupied. So at that date, you would debit your PPE with the fair value of the building on that date, which was 4 million. All right, this is the fair value that were given on 30th of September. And you will credit your investment property. $4 million. So we have to deal with this transfer out of investment property, which occurred on 30th of September. Let me go back to the solution. The transfer out of investment property, this Joburg property, we have a minus 4 million. All right, you see it here, minus 4 million. Maybe I should put that in red to show that you're subtracting it. Okay, because that property, we're removing it from our investment property because it became owner occupied property. Are we together?
Yes, sir.
Okay, let me just put this. This is a transfer from IP to PPE. Okay. And then we have our fair value adjustments. Now I've done the journal entries for the fair value adjustments. Okay, so anytime we credited the fair value adjustment, it means it increased the value of our investment property because we would in turn debit our investment property. So let us look at this. Where a fair value adjustment, I want to use a different color. Okay, we'll use that color. We had a fair value adjustment on the 1st of March, which increased our investment property by 200,000. This is the Cape Town. Is this the Cape Town? This is the Bloemfontein property. And then we had another fair value adjustment. Oh, where's, okay, what happened here? This should be fair value adjustment. Okay, this property changed from being inventories to actually being investment property, isn't it? I just want to see which property this was, because I'm just missing this 500,000 workings. I mean to the, yeah, so sometimes you will have to go back to your theory. Okay, so this was the Cape Town property, sorry. And this was the Cape Town property where it had been held for sale in the ordinary course of business. It had been held for sale in the ordinary course of business, and then it became investment property. All right, and then it became investment property. So this fair value adjustment here, I had the date wrong. This was on 31. This was on 31 December 2015. So initially we had the fair value adjustment when it was brought into investment properties from inventories, because remember, inventories are carried at the lower of cost or net realizable value. So we just transferred it at its carrying amount, and then we had to do a fair value adjustment. And then we had to do another fair value adjustment on 31 December 2015. So I just put the incorrect date. So I'll highlight this one in blue. That's another fair value adjustment that increased the value of our investment property. Let us go to the next fair value adjustment that we have. The next one is for the Durban property, where we have another 500,000 fair value adjustment that increased the value of our property. And lastly, we have another one for the Joburg property, which is 1 million. So all the items in blue, we will add together. The 200,000 plus the 500,000, that gives us 700,000. Plus the 500,000, that's 1.2 million. Plus another 1 million. That gives us a total of 2.2 million. Those are our fair value adjustments. Now we have to include the fair value adjustments. All right. Let me just change the workings there. And our fair value adjustments actually increased the value of our investment property by 2.2 million. This 700,000, let me just break it down. It was 200,000 plus 500,000. Okay. So it's 200,000 when we transferred the inventory to investment property. And then for that property, we had another 500,000 at the end of the year. We had the 500,000 for the Durban property and 1 million for the Joburg property. And we come to an amount of 2.2 million. Are we together?
Yes, sir.
All right. Then all we have to do is just to reconcile it. We have entered everything. So we take your 3 million that we started with. We add the additions to investment property, which is 800,000 plus the 3.2 million. We subtract the 4 million that was transferred out of investment property, and we add the fair value adjustment of 2.2 million. If you add all of these together, these ones that are highlighted, you should get an amount of 5.2 million. Okay, let me put these. Okay, let me put all of these together. If you add all of those together, you're going to get 5.2 million, which is our fair value at 31 December 20X5. Are we together? Do you have any questions? Hello? Are there any questions? Okay, it seems there are no questions. I will post the solution on Teams. All right, I'll post, this question was from Gripping Up, so I'll just post the Gripping Up solutions there and you can go through that. All right, I'll also post my solutions since I prepared journal entries and you're not required to prepare journal entries. Okay. All right, someone says they'll make a consultation. All right. So that is fine. I want to share one more thing with you before we end today's class. And we'll be very quick. Oh, okay. We'll be very quick here. This is the last slide on investment properties. And what we're going to look at, we're just going to look at the profit before tax note and the investment property presentation and disclosure. Okay, the reason I just wanted to do this is because we had dealt with the question. The question was asking us to prepare the profit before tax note, and then obviously we had to do the investment property reconciliation note. So let me open. You should have been taught this. I'm not so sure if you were in first year, but I just want to show you the profit before tax note and what it entails. All right. What page is this? I just need to go up a bit. So this is the first year textbook that we use for the CA students. And what I just wanted to show you with regards to profit before tax note. With the profit before tax note, there are certain items that you will include in your profit before tax note. And as I told you before, you have income items and you have expense items. So some examples of income items that will be included in your profit before tax note is items such as profit on disposal of PPE and intangible assets. If you have insurance compensation in respect of, let's say, inventory that was destroyed, and also PPE that was destroyed, any profits on disposal of investments, profits on fair value adjustments of listed shares, profits with the fair value of adjustments of investment property, and this is what we were dealing with now. So any profits on fair value adjustments of investment property will be under the property profit before tax note. Rent income from investment property. So this is one item that is shown under the profit before tax note, and that is what we did yesterday. What type of expenses will be included in the profit before tax note? All right. So our expenses that would include depreciation, impairment losses are included in your profit before tax note. Loss on write down to inventories, loss with the fair value adjustment of investments in listed shares, loss with the fair value adjustment of investment property, loss on disposal of PPE. All right. So these are the types of expenses that can be used in, that will be reflected in your profit before tax note. Employee-based expenses. So I just want to show you how, so that just gives us a summary of what can appear in the profit before tax note, but what would it actually look like? Okay, this was on page. So this question gave it gave an example, and it asked students to actually disclose the profit before tax note, that to prepare the financial statements and then disclose the profit before tax note. All right. So straightforward profit before tax note is shown inter alia. The following, after inter alia, the following items, which are items additional to the notes to the items in notes 5 to 8. All right. So inter alia means just in addition to. And what did they show in this example? They had profit on disposal of plant, they had rent income, insurance compensations for vehicles, insurance compensation in respect of inventories. And what did they show under expenses? Just depreciation, impairment losses, loss with the write-off of inventory to net realizable value, employee benefits, technical services, etc. All right, so profit before tax note is not really confusing. It's just a list of some income and expense items that should be disclosed separately. And the reason for that is normally what happens is when financial statements are prepared, normally by big companies, they'll prepare financial statements in accordance with the function method. All right, so the statement of profit or loss and other comprehensive income will be prepared in accordance with the function method, which means that expenses will be categorized according to their functions, and the functions that we have are things like advertising, administration costs, distribution costs, and then other expenses. Okay, so those are the only types of those are the only functions that are shown under the function method, but then you don't have detail as to what exactly those expenses comprise. So that's why you need the profit before tax note, just to go into specific details that other expenses include items such as depreciation, impairment losses, etc., etc. Okay, so that's the profit before tax note. And then the last one that I want to deal with is I want us to look at financial statements, actually to see the presentation and disclosure, of financial statements of investment property in financial statements. So I downloaded the financial statements of Oryx Properties. Obviously, we know Oryx Properties is a company that deals with properties in Namibia. They have different properties like Marua Mall, they have like Gustav Voigt, etc. And so these properties are classified as investment properties for them. So let us look at what their financials would look like. Okay. So these are the financial statements, the integrated annual report for the period ended 2021. Let me just look at the slides just to see which page. Page 98. Right. Need to look at page 98. I'll just say 100. Okay. All right. So if we look at this financial statements, we start with the consolidated statement of financial position for the year ended 30 June 2021. So it shows the group as a whole and just the individual company as Oryx Properties. So their main asset that they present is investment property. And in this column, you have something that says notes, and it refers us to note number 6. All right, it refers us to note number 6. So we're given investment properties at valuation, and then we have some straight line adjustments. So first of all, we're looking at the face of the financial statements. You see, investment property is shown just as one line item. They just show one figure. So the company has 636 million, right, worth of investment property, because this amount is reflected in thousands, all right? While the group, they have 2.7 billion worth of investment properties. All right. So that's the statement of financial position. We'll go and look at the note 6 later on. And we have the consolidated and separate statements of comprehensive income. So this is the statement of financial position and other comprehensive income. So we have our revenue. Revenue is shown, the operating income from the revenue that is shown, this 115 million for the company, while the group has 340 million, if I'm correct, if I'm reading that correct. All right. So obviously, since investment property, most of this income is derived from rental income. And then it refers us to note number 5. It refers us to revenue, refers us to note number 5. Okay. I want to go back to the slides just to see what else do we have that I missed? Fair value adjustments of investment property. You see here we have our changes in the fair value of investment property. These are fair value adjustments that were given. 15 million for the company, 94 million for the group. All right. So you see, when we say our fair value adjustment goes to the statement of property, statement of profit or loss, this is where now they have shown our fair value adjustments. And the last thing that I want us to look at is the notes to the financial statements. All right, let me just move on. The first note that we're going to look at is the accounting policy note, which I told you that you don't really have to do, and you won't really be required to prepare an accounting policy note. But the accounting policy note tells you how the group deals with the investment properties. All right, so let us look at this. The group applies the fair value model to all the investment properties. Investment properties consist of land and buildings, installed equipment, and undeveloped land to earn rental income for long-term and subsequent capital appreciation. So this is what you were taught, that land that is held for capital appreciation or buildings, etc., will be classified as investment property. Investment properties are initially recorded at cost, including transaction costs. Subsequent expenditure other than tenant installation costs relating to investment property is capitalized when it's probable that future economic benefits from the use of the asset will be increased. All other subsequent expenditure is recognized as an expense in the period in which it's incurred. So all of this you have learned, and you see it is just what is taught is just put. What companies will do is that they'll have this template, all right? They'll have the template whereby they have all their accounting policies. So you usually do not have to learn this, all right? You usually don't have to learn this. I just want to read one, the third paragraph. After initial recognition, investment properties are measured at fair value. Fair values are determined biannually. Gains or losses arising from changes in fair values are included in the net profit or loss in the period in which they arise and are excluded in determining distributable income. All right, okay, I will skip the rest of this. I'll post this up for you if you want to read it, just so that you have an idea. I want to go to the revenue note, because the revenue note included other income or rental income. All right, so rental income, we have basic rental income, etc. What to that turnover rental, I don't understand what it is. Late payment, interest, and penalties on operating income. So these are all different types of income, all right, that they have. So their revenue, most of their revenue is derived from rental income. However, they have some income from interest payments. All right. The straight line adjustments for the income, I think this has to deal with leases, but we are not going to deal with leases in this this year. We're not going to deal with IFRS 15. All right. And then the last thing that I want to show you is the investment property note. So when we looked at the accounting policy, they told us that the investment properties are measured at fair value. So they don't have any cost. They don't have investment property that is dealt or handled or treated in terms of the cost model. All of the investment property is dealt with under the fair value model. So we have a balance at fair value at the beginning of the year. That's the amount. So you initially had your investment properties at valuation, cumulative rental straight line adjustments. I'm not so sure what this is. I assume it has to do with their operating their leases. All right. But we can ignore this for now because it's not relevant for us. Then you have any additions. This would have been property that they bought during the year. And then you have your fair value adjustments, all right? Then you have your fair value adjustments. Again, I'm going to skip the rental straight line adjustment. Then you get your balance at the end of the year. Okay, so the format, if you look at different companies and you look at the investment property, you should have a similar format, all right? Some of these items may not be included, like this rental adjustments. Okay. Do you have any questions? Do you have any questions? Let me just